Hello, everyone. Welcome to our today's session. Today, I would want us to look at the Ipsas, International Public Sector Accounting Standards, Ipsas. Now, remember, it will be very important for us to take note of IFRS. When we talk over IFRS, International Financial Reporting Standards, these are basically standards that profit-making organizations use to present their financial statement. So basically, IFRS are for what here? Private sector, what we call the profit-making organizations. Accounting standards for profit-making organizations. Remember, still in this set of profit-making organizations accounting standards, we still have what we call IAS, International Accounting Standards, but they're being phased out gradually by IFRS. So at the end of the day, the IFRSs will be taking over. And then now we have International Public Sector Accounting Standards, Ipsas. Ipsas, basically, these are used by public organizations, or basically those organizations whose objective is not to make profits. The objective of organizations that will be using Ipsas to report their financial transactions, ladies and gentlemen, do not have any profit motive. So I hope, first of all, from the word go, you are able to get that difference that Ipsas, we apply Ipsas for which organizations? Public sector entities, the government, the parastatals, government agencies, etc. They'll be using what we call Ipsas. And remember, apart from government entities, we also have like non-governmental organizations being not after any profit. So also NGOs like the UN, World Food Program, they use Ipsas in their financial reporting. Now, ladies and gentlemen, what are the key benefits of introducing Ipsas? The key benefits of Ipsas. If you are a government agency, why should you have Ipsas in place? It will be very important for us to appreciate the fact that most government agencies have been using what we call cash basis of accounting or cash accounting. Under cash accounting, what do we have under cash accounting? So under cash accounting, assuming, for example, in a given year, like as an RCM, assuming in a given year, we had students who booked for our courses. Of course, not all of you happen to be paying us upfront. So assuming that we had students who booked for our last year's courses were supposed to pay us, for example, 12 million Kenya shillings. 12 million Kenya shillings. But at the end of the day, of course, as I told you, they don't pay us upfront everything. Normally what happens, some students will come and say, hey, things are not looking up. Hey, could you kindly give me 2 or 3 months? So it will reach end of the year and you realize that we still have some 2 million Kenya shillings outstanding. So in this case here, the cash here that we have received is 10 million. Under cash basis, you cannot account for what you have not received. So remember, this is what you have earned. This is what you earned. This is what you earned. And this is the cash receipt. So if it's cash basis, ladies and gentlemen, of accounting, we shall only account for revenues of 10 million. Also, the same is applicable to what here? Expenditure, that we only account for an expense once we make the payment. It's called a cash basis. When it comes to Ipsas, when you adopt Ipsas, International Public Sector Accounting Standards, they are based on what we call accrual. Accrual means what? Accrual means that even if you have not received this money, so long as you delivered the service, you must, in this case here, account for everything that you earned. So if it's accrual Ipsas, then straight away here, as RCM would have accounted for how much? For 12 million. The other 2 million, which we never received, of course, will be falling under what we call the receivables. Will be falling under what we call the receivables. Then what are the main advantages? What are the main advantages of this Ipsas? Main advantages of the Ipsas. Any organization that adopts Ipsas as a tool, as standards of accountability, then number one, the financial statements here will be taken to be very reliable. So reliability, it boosts reliability of the financial statements. Remember, most of these government body entities, at the end of the day, they may need some donations. They may need some funding from external agencies. So external agencies will always believe in financial statements that have been prepared under Ipsas, and they become more reliable. I happen to be the consultant that did Ipsas for this big body, regional body called IGAD. Where was IGAD in this case here financing this heavy investment of doing their financial statements using Ipsas? It's because the donor agencies had insisted that they wanted accounting which were compliant, Ipsas compliant. Right? That's number one, reliability. Number two, ladies and gentlemen, we have the concept of consistency. Consistency, that if all organizations, government agencies, government bodies were to adopt and develop their financial statements using Ipsas, then somebody will be able to compare. Say this is, for example, right, Kenyatta National Hospital financial statements versus Treasury financial statements, and they'll be able to see uniformity like that. So consistency, of course, will lead to what we call comparability, like that. And then, ladies and gentlemen, number three, I hope you're following. Number three, we have the concept of accountability and transparency. Accountability and transparency. Accountability and transparency. So remember, the moment you go for Ipsas, chances of you hiding anything, for example, in terms of you having a lot of payables, you'd want to hide some of the liabilities that you have, cannot happen under Ipsas. This is Ipsas accrual. So it means that we shall be really a glass that can be seen through, transparent. And once we are transparent, then people to take up responsibility for whatever wrongs they do will be quite easy. So accountability and transparency. Ladies and gentlemen, the moment in this case here you go the Ipsas way, automatically Ipsas financial statements here that are compliant with that are Ipsas compliant will always aid decision making. Aid decision making. I mean, they are quite simplified, right? So making decisions using them will be quite easy. Great. Of course, there are so many of them, but for the sake of your exams, let's just stick with these four. We go straight away to the next thing, which is the disadvantages, the challenges, disadvantages. Remember, they are international public sector. When they're international public sector accounting standards, the first challenge, of course, will be something to do with language barrier between nations, language barrier. Look at, for example, a country like China. China, in this case, will tell their people and the public institutions to produce their financial statements in their language, which is Chinese. So as much as we talk about comparability, I mean, how do you compare? This is in English, another one is in Chinese, so that complicates everything. So we have the concept of the concept of language barrier. And then we also have the concept of conflicts between the Ipsas and the local standards. Like remember in Kenya here, we used to have Kenya accounting standards, although ours, we were able to do away with this completely. But there are still countries like when you go to Sweden, they have their Swedish accounting standards. And the chances are, ladies and gentlemen, because of course, that is a different country from our, there is no way you'll be able to go and do what here, force them to adopt Ipsas. This is a big challenge. If in this case here we were to smoothen everything for Ipsas to take place quite easily, then we must do away with local standards. But for now, they are there. So many countries still are running their local accounting standards. Very good. So I hope this thing is making sense. And then we have, ladies and gentlemen, the concept of independence. The concept of independence, or sovereignty. Sovereignty of what here? Of countries, or sovereignty of countries. Countries feel that they're independent. Why should you force us to adopt these international themes? Ladies and gentlemen, number 4, we have here lack of what here? Lack of skills. This is a big disadvantage, a big impediment. We have number 5, so lack of skills. Number 5, of course, this thing could be what here? Very expensive. Could be very expensive. I told you, like IGAD had to bring in consultants, external, right? And I was not the only one. It was a team, a pool of people. All that means what here? More resources being required to implement what here? To implement these Ipsas. So then, ladies and gentlemen, straight away, we shall be able to look at the differences between a public sector and a private sector. Differences between a public sector, and then what here? Private sector. Differences. Number 1, accounting standards. So of course, public sector makes use of what here? It makes use of Ipsas. This one here makes use of what here? It makes use of IFRS or IFRS or IAS. Very important of us to appreciate that. We have in this case here the major objective. The major objective, ladies and gentlemen, remember, public sector is not out there to make profits. Public sector, we are out there simply to serve. Ours in this case here is service to the public. Service to the public. So we can only talk over value for money audits. We can only talk over value for what here? For money. How about private sector? It goes without saying that private sector really is all about what here? It's all about profit like that. Profit. Okay. So we have, ladies and gentlemen, the third difference. Who are the owners? So ownership, ladies and gentlemen, public sector, of course, we have the citizens. The citizens are the ones in this case here who own public sector. Of course, we appreciate the fact that we have an agent as citizens. We have an agent in the name of what here? Government. In the name of government. Who owns the private sector? Private sector is owned by shareholders or investors. Shareholders or investors. From there, we have funding. Number 4, funding. Ladies and gentlemen, funding. We know that the public sector, again, is being funded by who? Citizens. Is being funded by citizens through what here? The taxes we pay. Through KRA. How about private sector? Private sector funding, of course, we have who? Shareholders. And in either case, we'll still be talking of borrowing. The public sector borrows heavily. Also, the private sector does what here? Borrows heavily. Now, from there, ladies and gentlemen, we'll go straight away to Ipsas 1. Ipsas 1, International Public Sector Accounting Standard number 1 talks about presentation of financial statements, and I would want us to look at a question here. We look at a question here. This question is a question that I got from May 2015. September 2015. September 2015, question number, September 2015, question number 5. Question number 5B. The following information was extracted from the books of the Ministry of Tourism for the fiscal year ended 30th June. So what do they want me to do? They want me, number one, to give them a statement of financial performance for the year ended 30th June 2015. So statement of financial performance, this is what we normally call an income statement. Statement of financial performance is what we call an income statement under IFRS, or a statement of comprehensive incomes. In the public sector, they call it what here? Statement of financial performance. From there, ladies and gentlemen, part B, they want us to give them a statement of financial position. So then what you do, you simply go through each of the transactions given here. Like we know accumulated fund. The first one is accumulated fund, and you have to tick it. Accumulated fund, of course, is what we call what here? Is what we call equity under IFRS. Government, we don't call it equity. We call it accumulated fund. So where will you take accumulated fund? Equity normally goes to the balance sheet. So if I were you, I would have written there very fast under accumulated fund, just beside there, I'll write accumulated fund into bracket balance sheet or statement of financial position, statement of financial position. So we have cash and cash equivalent. This will go to the statement of financial position. Receivables will go to the statement of financial position. Inventory, statement of financial position. Transfers, this is our revenue. Fees, fines, and licenses. So revenue, of course, goes to the income statement. Statement of performance. Fees, fines, and licenses. It is us who has issued licenses out there. So we are receiving this money. Liability for long-term benefits. This is a balance sheet or a statement of financial position. Long-term borrowing is a statement of financial position. Finance cost, this is a statement of financial performance. Supplies and consumables used, remember. So statement of financial performance. Wages and salaries is an expense, statement of financial performance. Other expenses, statement of financial performance. Transfers from other ministries gave us money. Transfers from other ministries, they gave us money. That's revenue to us. So this automatically goes to the statement of financial performance, right? Transfers to other ministries, we paid money. We paid money. It's an expense to us. So straight away, these will go to statement of financial performance. Computer equipment, these are assets. Vehicles are our assets. Land and buildings, these are our assets. So those three, straight away, if they are assets, they'll go to the statement of financial position. Then we have revenue from exchange transactions. The other revenue, of course, that will go to where? That will go to the statement of financial performance, which is our income statement in the language of a private sector. Payables and reserves, those ones will go to where? Those ones will go straight away to the statement of financial position. So once you've been able to map out that one, then everything becomes very easy. What I'll do, I hope my cameraman will be able to see up to here. So we have here statement of financial performance, right? And then we have statement of financial position. Remember, both we are looking at Ministry of who? Tourism. Ministry of Tourism. We are looking at Ministry of Tourism. We are looking at Ministry of Tourism for both, for the period given there. So we start with, very good. We start with our question like this. So what do we have here? The first one is accumulated fund. If you remember accumulated fund, we've said already where it should go. This should go to the statement of financial position. So under statement of financial position, normally what do we have? What do we have? Under statement of financial position, normally we have our assets. Our assets will be categorized into two. We have the non-current assets, right? We have here the current assets for us to be able to get the total assets. And then now we have what we call equity and who? And liabilities. Equity and liabilities, of course, we don't talk of equity. Here we talk of accumulated fund. We talk of accumulated fund and liabilities. Accumulated fund and who? liabilities like that. So the first one that these guys have spoken about is the accumulated fund. The first one is the accumulated fund. I'll be able to pick it. No, before I even pick it, remember the other one? The other one is which one? The other one, this one here is about our revenue versus what here? Expenses. So we have in this case here our revenue or our income versus our expenses. You simply structure them that way. So it becomes very easy for you to pick out things and slot them in. So what we have here, ladies and gentlemen, is quite a simple thing. So the first one is the accumulated fund. So this one I'm bringing it under the statement of financial position. So accumulated fund. So accumulated fund is 562,500. 562,500. Let me in this case here expose my screen for you to be able to see my screen very well. Accumulated fund, I've brought it under here. Right, great. So go and pick the next thing, ladies and gentlemen. The next thing is called cash and cash equivalents. Of course, cash and cash equivalent, this money that we have, this is a current asset. So under current assets, come and have here cash and the cash equivalent. Over how much? Cash and cash equivalent over how much? I hope you are able to see here, cash and cash equivalent of 375,000. Cash and cash equivalent of 375,000. Ladies and gentlemen, apart from that, we have received, of course, you know, receivables without being told by anybody. This comes under current assets. So we have receivables here, receivables under current assets. Receivables over how much? Receivables of 150,000. Receivables of 150,000. That is receivables of 150,000. Receivables are brought receivables under current assets. The next item, and for you, your case is quite easy because you are simply ticking as we get along. So the next one is inventory. That comes here, inventory of consumables. So we have inventory of consumables. Inventory of consumables, how much do we have there? We have 75,000. Inventory of consumables, we have 75,000. So inventory of consumables, how much? 75,000. Thank you very much. Inventory of consumables, great. So we pick the next one. The next item, ladies and gentlemen, that we have here, next item is transfers from exchequer. So transfers from exchequer over 1875,000. Transfers from exchequer of 1875,000, we have received this money from the government. It's an income to us. So come the income statement and mention there under the incomes, mention there transfer from exchequer. Transfer from exchequer, 1875,000. Great. We are doing well. Go to the next one, ladies and gentlemen. Fees, fines, and licenses. This is an income. This is an income of 375,000. So fees, fines, and licenses, it's an income. Fees, fines, and the licenses of 375,000, that's an income. You put it there, all right? You go on the next one. The next one, what do we have here? Liability for long-term benefits. So liability for long-term benefits, this is a statement of financial position. So 150,000. So under liabilities here, we have accumulated the fund and liabilities. So we have a very important liability here, a very important liability called liability for long-term benefits. Liability for long-term benefits. Please, you have to leave some space here because later on you'll be getting the total, right? So they can now come and begin with the liabilities, the non-current liabilities. So we start with the first liability there, which is liability for what year? Liability for. So the next one here is liability for what year? Long-term benefits. So liability for long-term benefit. Liability for long-term benefit. So liability for long-term benefit, what do we have? Liability for long-term benefit. Liability for long-term benefit, I can see 150,000. 150,000. So liability for long-term benefit, we have 150,000. Then I can see we have a long-term borrowing there. Long-term borrowing. Long-term borrowing. So long-term borrowing. Long-term borrowing, what do we have here for long-term borrowing? Long-term borrowing, for long-term borrowing, they have given us a figure. Long-term borrowing, 750,000. I hope you're able to see 750,000. Long-term borrowing, 750,000. Long-term borrowing, we have 750,000. Now, ladies and gentlemen, after long-term borrowing, the next item here is the finance cost of 75,000. Finance cost, that is interest. That automatically comes to the expenses. So finance cost here, finance cost of 75,000, right? It's an expense which I'll be able to subtract here. Finance cost 75,000. Finance cost 75,000. We have supplies and the consumables used 300,000. That's an expense. Supplies and consumables used. So we have here supplies and the consumables used of 375,000. 375,000. No, 300,000, sorry. 300,000. 300,000. Consumables and supplies are 300,000. I've made a change here, please. After that, ladies and gentlemen, what do we have next? After that, we have wages and salaries of 750,000. So we have wages and salaries. So we have wages and the salaries of 750,000, like that. Wages and salaries of 750,000. 750,000, it's an expense, remember that one, right? We're almost finishing. After that, we have other expenses of 900,000. We know where that will go. Other expenses of 900,000. So we have other expenses of 900,000. It's an expense, 900,000. I'll be deducting this from the incomes. That's why I'm putting them in the brackets, right? After that, ladies and gentlemen, what else do we have? After that, we have transfers from other ministries. So we received. It's an income. It's an income. Transfer from other ministries of 37,500. Okay, so transfers from other ministries, that's an income. Transfers from other ministries. So we have transfers from other ministries. So transfers from other ministries, what do we have? Transfers from other ministry, transfers from other ministries. We have 37,500. So 37,500. And then on the same breath, we have transfers to other, we gave other ministries money, we are good. We gave other ministries money. So transfers to other ministries, that automatically would fall under payments, And by the way, for us in the public sector, mostly we'll be calling these what here? Payments. The payments. So we have here transfers to other ministries. So transfers to other ministries over how much? Transfers to other ministries over how much? Transfers to other ministries of 375,000. 375,000. It's a cash outflow. So I have to put in the brackets like that, right? Right. Yeah. So in this case here, what do we have, ladies and gentlemen? So transfers to other ministries, already you have been able to book that one. From there, what next? The next thing that we have, ladies and gentlemen, here is called computer equipment. So computer equipment, of course, this must be an asset to the ministry. So computer equipment, 200,000. So it's an asset and a long-term asset for that matter, long-term. So it falls under what we call non-current, long-term because computers will stay with them. So we have here computer equipment over how much? Computer equipment over how much? Computer equipment over 200,000. Computer equipment of 200,000. Great. The next one, ladies and gentlemen, what do we have here? The next one, what do we have here? Is vehicles. Vehicles, 175,000. So vehicles will be, these are our assets. These are our assets. So vehicles here. So vehicles, we have 175,000. Vehicles, we have 175,000. Vehicles, we have 175,000. Then we have land and buildings, 25,000. Land and buildings, these are our assets. So we have land and buildings, 25,000. Those are our assets, land and buildings, right? Now from there, ladies and gentlemen, we have the next one, 2625. This is supposed to be 26,25,000, not 75. The next one is revenue from exchange transactions, 75,000 revenue. That will be falling under our incomes or receipts. Receipts. So we have here revenue from exchange transactions. I'll be able to define for you what this means. So how much are we talking about? We are talking about this amount. We are talking about 75,000. So we have here 75,000, right? After that, ladies and gentlemen, we go to the next one. The next one, what do we have here? The next one is other revenue. Great. Other revenue. So other revenue, how much? Other revenue is 450,000. Other revenue is 450,000. 450,000. 450,000. The other revenue is here. The other revenue is here, 450,000. After that, ladies and gentlemen, here we are. We have payables. Payables, of course, this will go to the liabilities. Liabilities, specifically current liabilities. Current liabilities, we have 375,000. So under our liabilities, if my friend could try to squeeze here, then we shall be able to have what we call long-term liabilities. Long-term liabilities vis-a-vis who are short-term, or in this case here, what we call current liabilities. Current liabilities. So long-term liabilities are also known as what here? Non-current. So under our current liabilities, then we have our payables here. So we have our payables. Payables of how much? We have our payables. Payables of how much here, somebody? Payables of 375,000. Payables of 375,000. Payables of 375,000. And then lastly, ladies and gentlemen, I can see the last item here. The last item here is called reserves. Reserves is an equity component. Reserves is an equity component, so that will come under equity, which is an accumulated fund. So we have reserves. They're giving us a figure of what here as our reserve. Reserves, they're giving us 1,350,000. So reserves, we have 1,350,000. And then don't forget that the surplus for the year will also boost our equity. So in this case here, we have surplus for the year. Surplus for the year. So that is it. Now get your calculator here. We'll be able to come to this later. Get your calculator. When you get your calculator very fast, please take me up very fast. The figures are here very fast. We have 1875,000 plus 375,000 plus 37,500 plus 75,000 plus 450,000, which gives me 12,500. So 28 412,500 is our total receipt, minus 75,000, minus 300,000, minus 750,000, minus 900,000, minus 375,000, which will end up giving me a surplus of 412,500. So this is our surplus. We don't call it profit. So this surplus is what you bring here, 412,500. So once you have that, now what you need to do is to come and give us the totals here. Give us the total. First of all, start by giving us the total assets. Total assets, what do we have? We have 200,000, 200,000 plus 175, 175,000 plus 262, 262,500 plus 375,000 plus 150,000 plus 75,000, which gives me 1237,500. So this gives me 1237,500. So come and check how your accumulated fund and liabilities look like. So we have 562,500 plus 1350,000 plus 412,500 plus 150,000 plus 750 actually, 1,000 plus 375,000, which will end up giving us, I have to repeat this a little bit, 562,500, right? We have here land and buildings. It is 25,000, right? So I'm being told this is supposed to be a total of 3.6 million. And then we repeat the assets. Assets, we have 200,000 plus 1,750,000 plus 25, right? 1,000 plus 375,000 plus 150,000 plus 75,000. Good. We have to repeat